Stockwatch is brought to you by Merchant West. Where others stop, we push further. Because we believe business as usual doesn't lead anywhere new. Go beyond with Merchant West. Finance, invest, insure.
You're watching Stockwatch. I'm Simon Brown, and joining me to unpack your stock-related questions today, Alex Duys from Umthombo Wealth, Graeme Körner from the Körner Perspective. Be sure to send questions. Email stockwatch@bdtv.co.za, SMS 41392, or on Twitter, Business Day TV, #Stockwatch. Gents, appreciate the time. Before we jump into stocks, I want to jump quickly into Chinese GDP. Graeme, 4.8 number, which was a little better than expected, but the worst we've seen in a bit. But not bad for the world's second biggest economy, considering trade wars out there. I mean, I don't know, 4.8 seemed quite chunky. And the Asian markets certainly liked it.
Yeah, I think definitely helping the Chinese market in Hong Kong. I think in Japan, probably more, the fact that, the current political crisis is maybe settling and hopes of stimulus there. But yeah, coming back to the Chinese GDP data, Simon, my sense is, it was a little bit of a mixed bag. 4.8 in my mind is on the wrong side of 5. But I think what the market liked was the fact that I think industrial production was up 6.5. So that sort of suggests that it's not all fall down in terms of the impact of tariffs. And we've seen that, consistently in the data coming through, that up until now, it's really largely corporate America and to a lesser extent the American consumer, and then a distant third in terms of suppliers into the US economy being hurt by tariffs. But I think the net is the markets are taking, comfort from the fact that in spite of a slightly softer consumer contribution, the impact of tariffs hasn't been as catastrophic as we might have thought in April.
Alex, that's a good point. It hasn't been, maybe we're seeing it a little bit in US inflation. Certainly it's edging higher. But the tariffs haven't been the absolute horror that everyone thought it would be way back in April on Liberation Day. They are messy. They get in the way. They're not good for a global economy, but perhaps not quite as bad as some of the worst case scenarios we had thought were possible.
Yeah, certainly not the worst case scenario, because the market has recovered quite a lot since the Liberation Day, right? So that tells you that the situation hasn't been as bad as of yet. I do think this will be phased in over time. So, for example, some of the increases, I think, from companies will happen proportionally over time, to perhaps once off, so that the consumers can perhaps ease into it. Otherwise, you could have a massive drop in demand. At the same time, I think the tariffs are being shared amongst, obviously, the producers, the consumers, and the different parts of the value chain, not all being allocated to one specific part of the value chain. So, but yeah, time will tell how that exactly works out. If there will be inflation, and if so, to what extent, and what impact it will have on global trade and dynamics, and so forth. But if you look at the Chinese economic update, the exports to obviously the United States have come down.
Yeah.
But they have offset it to other parts of the world. So yeah, I think that's pretty much what you're going to see, I guess, is you're going to see supply chains change a little bit, try to shift demand if you can. But yeah.
And I like your point about tariffs being shared. I was at a Citibank presentation earlier in the year, and they made the point that S&P 500 were at record margins, operating margins, so they had some wiggle room there. Question coming through around Spear. They obviously had results earlier this morning. They are very much the Cape Town focused. And the question, apart from results, question coming through, I hold this. It looked good to me. Is there anything I'm missing? Alex, your take on Spear, the REIT, and the numbers this morning?
Yeah, it's a good set of results. If you look at LTV at the moment, it's about 30%. So that gives them sizable ability to do acquisitions. I think one has already happened post this year, and then another one is going to also a little bit later. So they've got roughly about, call it 2 billion of dry powder if they target a 35% debt to NAV. So a lot of potential corporate activity. I also think they've been cleaning up the portfolio, reducing some of the office exposure and increasing the quality, specifically in industrials, logistics, as well as in the retail. So And I think it's safe to say that the Western Cape will probably outpace the rest of South Africa for at least the short to medium term. So I think the business is well positioned, good management, better quality portfolio, and will probably, if they want to do script, I think the demand will be there from institutional investors. So they're in a good position.
Graeme, your thoughts on Spear REIT?
Yeah, Simon, look, I've been fairly bearish on listed property for a very long time, and I don't want to rehash it all. I think I would agree with Alex that I think if you want to be in any part of South Africa in property, it's in the Western Cape. So I think that tilt definitely is in their favour. I still have some anxieties. Obviously, the smaller property companies have the opportunity to sort of navigate waters that maybe the bigger guys can't, where they're more sort of GDP and big picture proxies. But having said that, I'm still worried that there's a lot of space around. If you look at retail, there's just more and more of the stuff coming online. I think there are dynamic shifts there. We've all seen corporates, even where there's a back to work policy and working from offices, they're using much less of a footprint. So I still get the sense overridingly that there's too much, particularly retail and office around. Industrial, I think, is a specific opportunity, particularly in the sort of more niche around DCs and logistics hubs. But generally, I'm not a buyer of listed property right now. I think there's still headwinds, and some of those headwinds also are brought to us by local authorities and government and the likes of Eskom. So I'd rather just sit the listed property sector out en masse for now.
Graeme, question coming through, and in fact, it was waiting for you to come back on the show, and then this morning we got more updates. Here, of course, we're talking about Optasia. You've been chatting around Optasia via the EPE Capital Partners holding. Two questions in a sense. One is there still value in EPE? I mean, is it fully pricing in this IPO? And to be clear, we're not quite sure what the price is. And then your thoughts on Optasia as a potential add to a portfolio.
Yeah, so let me maybe deal the Optasia and add to the portfolio. I sincerely hope that Ethos don't flog all between 15 and 19 Rand, and that they are just part of the 30% offload, and that they actually distribute those shares. So I'm quietly hoping that our clients and our investors in our fund actually receive Optasia shares. The Optasia story sounds good, but you need to see it for what it is. It's obviously niche. It's got telephone numbers in terms of potential. I think they've got just over 100 million active customers, but there's a massive base within the MNOs that they partner with. So I think there's a lot of headroom. There's new markets that they can go into, new offerings. So I think most people I chat to sort of see this as a 20% plus EPS CAGR story for at least a few years to come. The question is, what's the right multiple for that? Being listed in South Africa, and I think that's probably logical because that's where the bulk of the register will sit. I don't think it's going to command sort of an AI type of premium. So I like the Optasia story. If you look at the 15 to 19 range, it's probably, if you look at it on a PEG basis, if you believe the nonsense I was talking about, the CAGR for the next few years, it's not expensive, but it's not a widow and orphan story, if I could answer it that way. So great story, but it's not to have 5 or 6% of your portfolio in. And then in terms of Ethos, you tell me what they're going to place these shares at, and a few other things. But I would argue my back of matchbox calcs, there's still quite a lot of headroom, because regardless, if they put this away at, let's say, $15, the implied NAV for Ethos is quite a lot higher than the current. The plan is very much to unlock that value. There is some stuff sitting in the exit lounge. So whether they sell everything in Optasia, which I'd cry about, or they sell some to help create the float and then unbundle the rest, I think there's a lot of value unlocked. And then if you get them or you get the cash, you can review what to do from there. But my guess is, if you've got 4% sitting in Ethos, that could very easily ratchet up to 5.5%, and you could see a significant part of that coming either as a special or in the form of Optasia shares. So yes, I think EPEs looks like a slam dunk to me at these levels. Getting shares, though, is a little bit more challenging.
Yeah, I take your point. Alex, for you, I mean, in some senses, I mean, it's an IPO, although it is also an exit as a majority, to be clear. It's got all the hype words, fintech, AI, and that always, I mean, flashbacks and to previous listing booms. Have you had a look at Optasia? Do you have thoughts on that 15 to 19 valuation?
Unfortunately, not informed views, as I haven't really gone through the detail on Optasia, but it's quite a complex business involved in over 38 countries, right? So you've got a lot of different geographic regions, currencies you need to think about. Obviously, they offer microfinance solutions, airtime credit solutions via, I think, 49 distribution partners and a bunch of banking partners. I haven't really checked their accounting just to see how conservative they are on earnings quality as well as how they provide for bad debts. I need to look at the funding structures, to see if there's any potential problems there over time. So, unfortunately, I need to do some more homework before I can give a view on the business. Certainly exciting that there's a new listing on the market, potentially high growth offer there, but I need to assess the opportunities in line with the risks for me to make a decision.
Yeah.
Unfortunately, just opportunity hasn't arisen to me yet, so I can do the work. So that's on my to-do list.
Yeah, okay, but I take your point. It is great to have a listing. We will take listings every day of the week. Alex, the questions coming through around nuclear. You actually spoke about it a couple of weeks ago, I think, and there were two questions. But the one part was, which was the ETF that Alex Duys was liking around nuclear?
Yeah, so the one I actually own in my personal capacity is the Global X Uranium ETF. It's the ticker is URA. So it pretty much invests in a broad range of companies, right? That's involved in uranium mining, production, nuclear components, etc. I think the top 10 is about 70% of the holdings of the NAV, and I think the top 2 is about 36. So it's reasonably diversified, but gives you a broad range of opportunities within uranium. It's quite sizable. I think it's got about 5.5 billion or so AUM under that structure. So that's the one I personally invest in. It's done quite well off late. It's not a direct uranium ETF. So you're buying rather companies that are directly or indirectly tied to the uranium market.
Graeme, nuclear, lots of talk. We've got our own finance minister, electricity minister saying nuclear is important. We've got the huge demand from AI, etc. The trick, of course, nuclear power stations are expensive, take a very, very long time. Is this a space that you've looked at, have views on, or, I mean, for me, to be honest, it's kind of passed me by.
In large part, it's passed me by too. I mean, obviously, if you look at something like Renogen and ASP isotopes, that could be an interesting angle. ASP could be an interesting angle. Obviously, not pure in terms of energy, but Simon, paradoxically, we're invested in a renewable fund, being Brookfield. You're probably aware of Brookfield. And they're very much in renewable. The name of the entity is Brookfield Renewable Energy Corp. And as the name suggests, they're invested into renewables because that's our view. If you want to decarbonize the global economy, you have to address the issue of the electricity grids. Point number one. Point number two, these data centers and these AI centers at the margin are consuming a lot of power, and it's got to come from somewhere. Now, although I would argue the case for renewables, the reality is that that's a slow grind, and it's probably not going to bring the kind of capacity online. So I think what's different this time around with nuclear is that there's new technology that's coming around. So in the old days, you would build a Coburg or the equivalent, or a Chernobyl or something like that, and these were massive and took a long time and very much like old school. But there's new technology coming around where. And you see the South African government, as you just say, committing to that. So I think if well managed and sensibly deployed and well maintained, nuclear definitely has a place in a lot of electricity grids. Obviously, after the incident in Japan, everybody got really scared. But if I remember correctly, at that time, nuclear represented over half of France's energy generation capacity. I think people have been sort of going away from it, but there's definitely a theme. So just like Optasia is Alex's homework, my homework is to spend more time on nuclear, because I think these AI centers, these hyperscaler centers, they're going to consume massive amounts of power, even if they're trying to make them energy efficient. And a lot of grids around the world are actually quite strained, even going into this boom. So I think there's a very strong case, yeah.
Yeah, absolutely. And that Brookfield's got a nice chunky dividend yield. Graeme, let's stay with you a moment. Question coming through around Sanlam. Is it worth a look? I especially like the India exposure. Graeme, Sanlam for you?
Yeah, look, I mean, for a while, I've sort of been banging the old mutual drum, on the basis that the combined value, so if you don't take not just the life business, but the other assets are trading at a sizable discount. But the reality of it is Old Mutual was a little bit broken a few years ago. Their internationalization strategy was a disaster, and they paid the price for that. And on the other hand, Sanlam, waited for the mist to clear and then went into really good markets. And I think India is going to be an amazing story for them. So, I'm late to the party, but Sanlam really does seem to be executing well. But I would still argue that there's an investment case if you want to be in that sector, and not specifically just chasing the Sanlam Indian exposure. I think there's still quite good value with probably relatively limited downside in Old Mutual at these levels.
Alex, Sanlam for you?
Yes, we do like Sanlam. I mean, I also recently had a capital markets day, pretty much highlighting the growth potential of the business and how cheap the valuation is. I mean, over the last 10 or so years, African life insurance companies have derated. However, they've grown quite nicely. And I think the prospect for Sanlam remains good. In SA, of course, we've got decent prospects, Africa, as well as India. They use, of course, very conservative accounting as well, which I think the market doesn't give them the credit for. And they've got many levers to pull. So Sanlam, in our view, is one of those put in the bottom drawer if you want to have South African financial exposure. And the current valuations levels, dividend yield of close to 5%. I think it's better relative to embedded value. It's I think around about 1, if I'm not mistaken. So it's probably a re-rating potential in the business combined with decent growth. So we like Sanlam.
Okay, but you like Sanlam. Sasol, stock hasn't been on the viewers for a while. The question is, Sasol back at 100 and coming downwards. Should I just give up on this one? And then they sent a follow-up to say, all my averaging down, I've got an average price of 80, but I'm overweight. Alex, Sasol, I mean, they've got low oil. I mean, the stories are legendary. Would you be still hanging on to Sasol, buying at these points? What's your take on Sasol?
It's very difficult for me. Simon, at the moment, it's more of a trader stock. Yeah. You can see if the stars align, this stock can easily double. Right? But at the same time, if the structural issues continue and they don't get bailed out by better chemical or oil prices, then the stock will continue to go backwards. So that's my issue. They also got a lot of debt as well they need to work through. So it's a difficult one. At the moment, I do not have a feeling of where Sasol is going to go to. So if you do want to take exposure, I'll say rather be more prudent, take a smaller position. If you get more evidence, you can ramp it up. But be cautious. The risks are high. Yes, I will certainly not advocate for a big aggressive position in Sasol.
Yeah, and that's the trick with averaging down, is that you end up with a lot of it, even at a better price. Graeme, Sasol?
I generally agree with Alex. I think it's kind of become a bit of a trader stock. I do think there's a plan from the new leadership and the board to extract value. And there are obviously there are definite challenges facing them, and it's not just the rand oil price. They've not executed offshore very well, but I do believe that if you break this up, it's probably worth quite a lot more. So even with oil where it is now slightly lower, if they were, for example, able to spin off the chemicals business and possibly maybe even sell more of the Lake Charles project. My sense is it's worth a hell of a lot more. The problem with it is, at its core, it is still an SA Synfuels play. That's really what's been largely the engine room. And unfortunately, they're a massive polluter, and one day they have to pay the price for that. So that's why I would agree with Alex that it's not, you can't take a 10-year view on Sasol the way you did 20 years ago. There are definitely more moving parts. It looks cheap, but I would agree with Alex. I think it's become a trading stock, So, if you bought them at 80, maybe you just say, look, I'm going to trade them in a band. You can sell some when you're 20% up and layer them on the way up. But I think you don't really want to hold this one for the next 5 years. I think it's, unless they do a massive value unlock strategy and execute on that, my sense is that it's a rusting asset.
Yeah, and both your points. It's a trading stock. I think that's the key point there. Quick before we go to a stock picks, question coming through. ShopRite surely offering value below 300. Graeme, it was 250 earlier in the year during the Liberation Day tariffs. It's run hard. ShopRite for you at now what, 294 odd?
Yeah, Simon. So I mean, for me, it's one of South Africa's amazing success stories. We've held it for a long time. We love the stock in our fund. We're pretty much out of it because I think we're very much value driven there. I think it's an amazing business. It's brilliantly run, well positioned. They're moving into new markets. My problem is that it's not going to deliver the kind of earnings growth that the market is discounting currently. So I just differ with some of my colleagues, but my sense is that at call it $300, there's a year or 2 years good news priced in. So I'm not disputing that it's a brilliant company and that they will deliver well, but I think 12% or thereabouts earnings growth is not going to unravel that PE fast enough. So I wouldn't be a buyer of ShopRite at $300, even though it's a brilliant company.
Yeah, I agreed on that. I mean, that PE is north of 20. It gives it a peg of some 1.5 or more. Alex, before stock picks, ShopRite for you?
Yeah, I mean, in investment terms, professional investors would refer to ShopRite probably as a growth at a reasonable price. So it deserves a premium rating. I think that's important to note. It'll probably grow earnings, call it 10% compounded over the next 5 to 10 years, which is a very good outcome. But most of that's already reflected in the share price. So ideally, you would like to hold the stock and buy on our weakness and build a position like that over time. But saying that, the stock hasn't been a great performer long term, right? Yeah. I mean, at 2013, the stock was right about 200. And I don't think it's much higher than the levels it was in 2018, when it was about 260 or something like that. So the stock, if you have to buy it when there's some short sell-offs. There was, of course, a big sell-off into COVID, and you alluded to Liberation Day. I would suggest wait for those, pick the stock up then, and then you hold it.
Yeah, $100 back in the pandemic. I remember that, but I was too busy wondering if the new CEO could do it instead of buying it. But let's go to some stock picks. Alex takes Rabex.
Yeah, so another SA in play today. I think Rabex for us offer a compelling short and medium play on SA fixed capital formation, especially if the private sector comes to play. And the private sector hasn't invested in SA for a long, long time. So they do have a, call it infrastructure part of the business, which we think will deliver a very good set of results. And at the same time, their Baobab business, which is predominantly in chrome, we expect it's going to go from loss-making to profits in the next set of results. And on top of that, we expect CapEx spending to reduce from Rabex. So that's also mean that better high free cash flow for investors going forward. And we don't think this is really reflected in the share price. And as a result, we think it offers a good, compelling opportunity at the moment.
And they've actually, they're one who's making Australia work well for them as well. Graeme, you're going with ABSA?
Yeah, why not? I do it every other time. So, Simon, I think, Alex was talking about a share that hasn't done much in ShopRite in share price terms. And he has another one, but the difference is, their earnings have doubled, and yet the share price is almost the same. So it's become, it's almost just too cheap. So, I'm a little bit, I'm not ashamed to say I'm a little bit confused by the state of world markets right now. There seems to be a real risk on almost in markets we trust kind of mentality. Mm-hmm. That kind of environment scares me, but you want to have chips on the table. And I think something like ABSA, if they're going to deliver almost $30 of earnings to December, at 190, that valuation is, I don't want to call it obscenely cheap, but it's I think there's a massive margin of safety. And the other margin of safety is in the divvy. If you're going to get $16 in divvy, you're looking at a divvy yield of almost 9%, even after DWT, you're beating cash. So I think it's just too cheap to ignore. And that's really for people who say, you know what, I don't know if I should be buying Optasia or Naspers or gold shares.
Yeah.
I just want something that I understand. That's really what I was looking for.
Yeah, and as has been said before on this show, a dividend yield that is way better than putting money in a savings account at the big banks. And then you get, of course, the optionality on the share price. That's all for Stockwatch today. Thanks to our guests, Alex Duys and Umthombo Wealth, going with Rabix, Graeme Körner from Körner Perspective with ABSA. Up next, The Close. Stay watching.
Stockwatch is brought to you by Merchant West. Where others stop, we push further. Because we believe business as usual doesn't lead anywhere new. Go beyond with Merchant West. Finance, invest, insure.